Well, hello, Matt.
JP, how you doing?
Doing great. Doing great. Wearing my purple shirt today. See that? It's all purple.
Nice,
I'm like an
nice.
eggplant.
Gives you a good power color there for you.
And part of power color is also power posture, right? So I've got my
Uh-huh.
leg spread apart and I've got my chest out, and it's all about physiology.
Absolutely, absolutely.
So, you came to me this morning with a great idea. You're like, JP, I'm paraphrasing, of course. JP, let's talk about our journey on Shaker 6. And
Yeah, it's really this is really all about real estate investing for beginners, right? We're relatively new in our journey here, so we figured that there's other beginners out there that can absolutely learn from some of the trials and tribulations, and we really want to be transparent with this as well. We want to sort of open the kimono here and show everyone what we are working on, what we have been working on, some of the challenges and things that have gone wrong, for
everything's a
us.
challenge, by the way. P.S.
Yes.
Spoiler alert, everything is a challenge.
So that's really what the genesis of this is all for, is to be able to help everyone learn from the different situations that we've run into by going after these multi-million dollar opportunities.
So let's talk about how we found the deal. And just for some quick background, we'll give high-level elements about the deal itself, and then we'll go into details. What we did is we broke out really aspects of the story along the way. And we hope that you as a listener or a viewer get some value out of this, because it has been a incredible journey, very stressful, but also rewarding. Jesse, our director of operations, he works next to me. We have this kind of running joke on how real estate or multifamily real estate is very much like a roller coaster ride. Literally every day, almost hour by hour,
Yeah.
your emotions are constantly swinging down, going up, down and up, just because you feel like you're making some really good progress or wins. You have a great call, and then another challenge lay before you, and that kind of sends things crashing down a little bit. And it's very, very emotional. So we're going to start with how we found the deal, and for that, Matt will go into that, because he's the finder. He's the guy that when he took his little shovel and dug it into some ground, it clanked on something. And so
yeah,
Matt, how did we find the deal? When was that?
So just real quick too, I think, what we're going to do, we're going to make this, sort of a series. So we obviously have a portfolio of properties that we already own. So we each deal, each opportunity has its own challenges and tribulations. So this particular story is about Shaker 6. We call it Shaker.
If you have children, ask them to leave the room.
Yeah.
Just kidding.
So Shaker 6 was nicknamed Shaker 6 because there are 6 separate buildings in this portfolio, and it's located in a suburb of Cleveland called Shaker Heights. So Shaker Heights was actually at one point one of the most affluent communities in the country, and it still is very, 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 very affluent. What is the average household income, JP?
It's in the $100,000 range. It depends on which source you look at, but it's very high up there. It's either at 6 figures or right above 6 figures or just below 6 figures, which is kind of irrelevant because that's really, really good.
Yep. So I've been in Northeast Ohio, in the Cleveland area, most of my life. So Shaker's always been one of the cities that is a desirable area to live. Very beautiful, beautiful houses. Actually, Rockefeller had huge mansions there. I mean, these places are just absolutely gorgeous. And it's like the old, 1920s style buildings, old, big, huge stone type buildings. I mean, really, really cool, unique properties in Shaker. So I saw this come up. So what we did early on in our investing career was to go to all of the different brokerages and put in our names and email addresses. So every day we basically are getting, what are the new deals that are out on the market, right? What's new, what's coming up. So I happened to see this one in Shaker Heights, and I'm like, oh, that's a great area. So told JP about it, and we're like, yeah, that doesn't look too bad. So I went and drove the properties. This was probably, I don't know, maybe November or so of 2019, something like that.
Yep.
And started reaching out to the broker at that point, and we started, going down this path of evaluating this property. All of the buildings were all brick. So, from a structure standpoint, you could tell that there wasn't any issues or anything like that with the buildings. I mean, no major cracks or anything like that. So, so really, I guess that was the genesis. That's how we ultimately ended up finding the deal, and then just reaching out to the broker and starting to dig into the specifics about that particular deal. So
yeah, so let's go into what we liked about it and what attracted us to the deal. So as Matt said, for me being in Georgia, Matt being in Ohio, really being eyes and ears on the ground that's local to the asset. By the way, if you want to start making a name for yourself and really becoming established in commercial real estate, you got to start speaking the language. Part of the language is calling properties assets or product. There you go, little tidbit. So what we looked at when we started looking at the deal, one of the first things we do is we throw on Google Maps and we look at where it is. We put in the satellite view and kind of see what's in the area. And in the OM, or the offer memorandum, the brochure, if you will, it pointed out that it was right across the street from this $100 million mixed use transit-oriented development, TOD. So mixed use.
Explain
TOD.
What that is real quick.
So TOD is, mixed use is, I think, what most people kind of like or they're attracted to today, which is basically commercial or retail on a first floor, and then residential living on top, so apartments on top. That's mixed use. And I think that's going to be the wave of the future. And then the TOD part really means that there is a transit station, a train station, or some kind of transit facility on the premises there, and which is, again, great because it means people don't have to use cars. They could you ride their bikes somewhere, and it's really where a lot of renters really want to be. And renters could be on the younger side, the millennial side, or they could be on the retiree echo boomer side, which are both huge demographics in commercial real estate for kind of the renter nation. So we've got this brand new $100 million facility or building that was built there. At this point, it was just about a year old, maybe roughly a year old, that came online. And it had become or was becoming a main magnet attraction for the area. When you looked on the map, you're like, well, we have these 6 properties, 5 of which are on the same street as this Van Aken district. And from our estimation, it looked very, very close. I think you could, at that point in our understanding, because we haven't really driven it, we figured you could very easily walk there, and it turns out you can. It was like a 3-minute walk. I recorded a video of doing a walk from one of the properties, but it's very, very close. And so we said to ourselves, well, man, all the properties that we look for, all these C class, B class, things that were built in the 60s, 70s, and 80s in Metro Atlanta or in Florida, very rarely are they located so close to this great attraction, right? Most of these things are in some kind of residential neighborhood, or they're off the beaten path a little bit. And that's, in our opinion, the holy grail. Holy grail is you want to find a product that was built a long time ago. So the replacement costs, it's low or high replacement cost. The cost to build something new would cost more than the cost of buying the property as it is, in a very attractive area. That's what you really want, right? That's going to help raise the tide for all the ships with respect to being successful in your plan, and maybe increasing rents or adding value or whatever your thing is that you want to do. So we loved the fact that this $100 million mixed-use facility was right there. And then we started digging into the market there. All right, great location. What's next? Where's the opportunity? Where's the opportunity to add value? And for those of you that are new listeners or kind of new in the multifamily space, value add is a phrase that you use to increase the valuation. So we'll talk about cap rate for a second. So in commercial real estate, a common term is cap rate. And cap rate really defines, it's a metric to help people understand if one buys a property or an asset for all cash, what sort of return would I see? Am I going to get 5% return on it, 10%, 8%, 9%, whatever? And that is kind of the metric used to help narrow down whether or not you're getting a good deal or a bad deal, or just understand what sort of mechanics the cash flow the deal kicks off. So when we were looking at this, we looked at how we can increase the valuation of the property. So we saw that there were some competitive apartments very close by, and some were leading the rents or capturing small amounts of increases, maybe $100, $200, and there were some that weren't that far away.
Which, by the way, is normally what you
That's right.
find in
Thank you.
most,
Thank you.
So you kind of poo-pooed that, but most of the time when you're looking for properties, you get $150, $200 rent bump after you do the renovations.
Yeah, after you
So
spend like $5 or $6 or $7,000 per unit to get that extra $100, and that's okay. We don't mean to poo-poo the $100, $200. That's normal what you see, but we were seeing that there was these properties. Another property that was down the road, built in the same era, in the '70s, and they did a fantastic job of improving the interiors. They put new flooring, they put new cabinets, they put new countertops, all the things that the kids like today, and they were getting on average $500 more in rent from what we were getting. So our thesis was, well, hold on, we've got our properties potentially located in a great location that you can throw a rocket at this Van Aken district. And this place that we're talking about here is 1.4 miles east of where it is, doesn't have the same access to transit, but they're getting $500 more a month in rent. Well, man, if we can get $400 or $300, then will surely be a slam dunk. And that's sort of what we underwrote for and how we built our business plan. And going back to the cap rate for a second. So in multifamily, this is kind of a important tangent, but it's hard to explain unless you kind of visually show it. Cap rates are important because every dollar that you add to your bottom line meaning the NOI, the net operating income. So you've got your rent that comes in, whatever you collect is your effective income. You got to pay your expenses, and that could be utilities, it could be property taxes, insurance, whatever. Whatever you're left over is your net operating income, your NOI. So every dollar that you can increase your NOI at lower cap rate levels, so 6%, 5%, 4%, has a tremendous multiplying effect on the value of the property. And that's what appraisers use to value the property, and ultimately what the banks rely on to value how much your property is worth. So that ties into when you go to sell it, or when you go to do a cash out refinance of the property, you want your NOI to be as high as possible so that you can get the maximum value out of it as a result of sale or as a result of a cash out refi. And so this place represented tremendous upside simply by the fact that we had a situation where the market rents were so far under market, and there was just a huge upside there, which will lead into another challenge that we ran into along the way of trying to convince people that the rents were that far under market. It was something that we could get into. So yeah, just wrapping it back up. We love the location. We love the potential upside in value add, right, Matt? And
absolutely.
And we saw that these buildings, from their condition, the brick buildings, there was an opportunity to restore these things back to their former glory, if you will. They were built in the 40s, 50s, and 60s. They were well built back then, and they had really good bones. And they just needed someone or a group to come in and put some proverbial elbow grease in there and make it shine again. And that's what we really saw. So we decided this seemed like a really good opportunity. We'll underwrite it, and we'll see what kind of returns it would present. And if it met our muster, which was about 15% plus internal rate of return over the whole deal, then it's something that we should go after. And we made the decision to go after it.
Yeah. So with that, again, this is going to be a series that we're going to do again, just talking about the ins and outs of what we're going through, what we're learning, what we're experiencing in these different opportunities. So this is kind of a recap of a project that we just went through. So tune in on the next episode, and we'll get into what the next steps were that we took in the process of acquiring these buildings.
Thanks, guys.
Take care.